Maybe you started investing recently. You want to reach financial freedom, dollar cost average over a week in your favorite stocks, grow sizable positions over time. Or maybe you've been an investor for a long time with strategies to buy and hold, but you'd like these long-term investments to bring you rent money, additional passive income money, the way a rental property does in the real estate market, right? What you might encounter is actually you do not have consistent cash flow to fund your account every week for various reasons, which can get you to miss opportunities for lack of available funds. Therefore, you feel like you constantly need to take profits on positions, reducing your equity in these companies you see going 10x in the future, but your account cannot grow 10x with that given stock if you're forced to sell a portion of your position along the way. So careful, I'm not saying that taking profits or even closing a winning trade is a bad thing, but how many of you bought and sold stocks like Neo, Square for 1/10 of what they're worth today? Yeah, it stinks, I know. What if I told you there's a trade you can make every Monday that's fun, entails low risk, consistent reward to generate buying power? So in dollars on your account, not capital gains from stocks in your account every new trading week, netting you between 4 and 10% profit per trade without you having to sell a single share in the process. Well, with that passive income strategy, you know you have money coming in every week, making you a lot less likely to panic sell or to take profits too early. For those of you already following my journey in the markets, you know I've been trading this strategy every week for the last 6 months, which I view as the nuclear engine of my overall growth strategy. It allowed me to steadily double my account from 8.3 thousand to roughly $17,000. Alrighty, you guessed it from the title of this video, the name of the strategy or option play is called the covered call strategy. I'll go in detail over why I consider this strategy to be the very best in the markets to grow your account, no matter the size. This is used on a daily basis by the biggest hedge fund manager in the world, such as Warren Buffett, Berkshire Hathaway, Vanguard, BlackRock, even your favorite fund manager, Kathy Wood from ARK Invest, is probably hedging her positions, her long positions with covered call options. All right, so for you to gain full value from this video, you'll have to understand what buying a call option means, what are the risks, and what are the different parameters, the 4 different parameters coming into play. So let's jump in a quick whiteboard right here. So quick reminder, when you say we have a daily stock, you bought it here, or you don't have to buy it here. You just want to buy a call option. So what happened? You decide that you want to buy a call option for the strike price K. So this is the share price. You will have to buy this contract for a small amount of money called premium. So basically this is the price of the option. And how do you make money from it? Well, if by an expiration date that's stated in that contract, the share price is above K plus P, so the strike price plus the premium you cashed in, then all of this difference, let's say stake does that, all of that difference goes into your pocket, right? So in order to make money from buying a call option, you need to be right on several things, right? You need to be right on the direction. The stock has to move up or down. So you have to predict the right direction. You have to predict the range of the move. So it has to go beyond the strike price. and the velocity or timing of the move. It needs to happen before expiration date. So you can see how it is actually very easy to lose money buying a call option because you only have to be wrong on one out of three conditions mentioned above, right? And this is why most people lose money buying call options. The game is pretty much rigged against us because the price of a call option is always sort of factoring in future movements. Market makers are not stupid. They're not placing losing bets just to lose money, right? Well, at the other end of this trade, someone has to be winning money if you're losing, right? Well, you're absolutely right. At the other end of this trade, there's me selling these call options, and hopefully you're joining me too soon because it's a beautiful place to be. All right, what are the steps and to the strategy and the thought process behind it? Let's get into this quick notepad I prepared. First of all, you need to own 100 shares of an uptrending stock. So stock you like, you're in for the long run. You do not want to sell to take profits, but you still want to make additional income from this stock slowly going up over time, okay? The stock must have weekly expiration dates. In our case, we're trying to make money every week. So every expiration date is a paycheck for you. You need to view it as is. And then what do? Come Monday or Tuesday, depending, let's say the opportunity doesn't present itself on Monday, you can still place it on Tuesday. But I'll go over why the beginning of the week is better than the end of the week. You sell a out of the money call option for the closest expiration date. So let's say, as you guys might know, I've been playing Riot blockchain quite a lot. I'm in for the long run. I'm super bullish on the whole industry, the Bitcoin, cryptocurrency industry, markets. I hold a big bag, allowing me to sell 3 contracts every week. Okay, so what, for example, what can we? So we pick a strike price that's far above the current share price. And the thought process is we wanted to remain out of the money because if the contract we sold remains out of the money, the other person on the other end of that trade is just losing their investment. The price of the premium they invested to buy that option will slowly go to zero. Okay, because this contract will have no intrinsic value. Let's say I sold a 11.5 covered call on Monday morning, Monday, December the 8th. And we look at what Riot did this week. It slowly bled out, right? So this call option has zero intrinsic value. It's not in the money, so holding it will bring your investment to zero. So this is why during the last week, out of the money options decay the fastest. So the whole point of this strategy is utilizing time decay in our favor during the last week before expiration, which is the period where the price of an option will decrease exponentially. All right, next. How do we pick the strike price? Well, we need that strike price to be far enough from the current share price so you're confident about it staying out of the money. But at the same time, it needs to be close enough to the current share price so the option premium you're collecting is worth your investment at the time. If you make a 0.5% trade, you're losing your time and you're basically locking in 100 shares that you could be doing something else with, right? So we want our time and money to be put to the best of its ability. So this will be based on your personal technical analysis and how well do you know the stocks? How well do you know the key levels of support and resistance? what is the shape of the ascending channel your stock is working in? And did it recently break that ascending channel? In our case, as you can see, Riot Blockchain recently did break this ascending channel. So we're on now in a fairly bearish pattern. The stock is making lower highs, lower lows. We do not know how low this can go, but I know that I can make money on the way down by simply picking a conservative strike price, let's say $10, sell a call, and here I place the amount of money I want to collect in the process. So these $50 per contract I collect go straight to my buying power. I am free to use it to buy other stock, to buy more Riot Blockchain if I want to. So by placing this trade, writing this call option on Monday, every Monday, you effectively give yourself buying power, and you create it out of thin air. You are leveraging your own positions to create passive income, and that's what I want you to focus on. That's what I want you to remember from this whole video, if there was anything to remember, right? So if we go back to this beautiful whiteboard of mine, on the other side, we are the option seller. What do we want to do? We always want to sell on momentum, okay? Why momentum? If a stock shoots up, the option premiums for all the different strike price on the option chain are going to shoot up as well. So you always want to sell your call. Let's say, yet again, like picking the strike price will be up to your personal risk tolerance. Like this could be right above, let's say this is 10.5. You could pick the 11. You could pick the 11.5. Basically, this is all based on your personal analysis and your conviction in the stock and how it'll move during these next 5 days, right? And then once you pick that, once you see momentum, so preferably on Monday or Tuesday, since it has more time on the contract, that's when you place your call. And the beauty of this strategy is you do not have to time the top perfectly, okay? You could totally sell that contract once you see that the stock is going back down a little bit. And hopefully you want it to keep going down a little bit, okay? What you do not want to happen is the stock to shoot past the strike price. This can happen, and I'll go over a specific use case that's applying to me currently and see what we can do when the call option we sold becomes in the money. Okay, let's get back to this. Okay, so let's say we sold our call on a spike, slowly comes back down. Best example is this week. Right, blockchain, we sell it here, it comes back down. The price of the option we sold, so for roughly, let's say $50, it's going to quickly go to zero because the markets are realizing that the lower Riot blockchain goes, the less likely it is that we'll go back above the strike price. So basically, the contract who already had zero intrinsic value is also losing its extrinsic value, which is the likelihood of the contract becoming in the money. Okay, so this is, we're effectively shorting our own stock, taking advantage of intra-week swings, right? What is the last step? We want to close our trade before the end of the week. I strongly recommend you guys close the trade and do not let it expire, because let's say you sold a call at $10. Riot blockchain beautifully went below, your call is out of the money. You win the trade. But sometimes the stock will shoot up after hours, and all of a sudden you the market is closed. I mean, this is past 4 p.m., so the options chain is closed. So you do not have the option to buy back the contract anymore. But your broker, for some reason, didn't close your trade yet. And what happens is you actually, the other person on the end of the trade becomes in the money, they're winning their trade, and your shares are called away from you, like on Friday afternoon after hours. It's a terrible feeling. It happened to me before. I was just greedy, thinking that, yeah, the stock was remaining below, nothing to do. Robinhood will close my trades for me. Wrong. Always try and close it for the minimum amount. So the minimum amount will either be $5, sometimes it's $1. Most of the time, it's the smallest increment possible is $5. Okay. And that's about it. Once you close the trade, your shares are freed from the collateral, and you're free to sell another call for next week. You can do it sometimes even for the same week. Let's say Riot completely dropped on Wednesday. Your call is worth nothing on Wednesday. You're free to buy it back for $5 and then sell another call. Let's say for a lower strike price, but for the same Friday. So you actually can play the short game twice during the same week on the same expiration. So there are many things possible with this strategy, and the thought process should be every block of 100 shares you own should be an ammo, and the goal is to collect money from that one shot, okay, and trying to make the cleanest trade as possible, and hopefully get back your arrow. Okay, not an ammo. Let's see it as an arrow. Closing your trade means you pick up the arrow from the tree you shot it to, and you put it back in your quiver, allowing you to play it once again. I think it's a good analogy. All right. Now, what are the pros and the cons of this strategy? The pros, well, I think you understood it. Like, it allows you to generate additional income that you would not have been able to by just holding the stock. Okay. One other great advantage is it makes you a better trader in the sense that your bias will change more easily. You have to shift your typical long bias to being a short-term bear in this case. And this makes you a better trader, more realistic, less idealistic. One other pro, obviously, is to make money when the stock goes down or stays flat, or even when the stock goes up, as long as it remains below your strike price. And this whole active management makes it that you actually get to know your stocks very well, knowing all the key levels of support and resistance. So this active management can give you a little bit more action versus just owning a stock and forgetting about it. So I think it has this entertainment component to it that I think is very interesting. It makes it fun. The risks of the strategy, though, are the same risks as the risk related to shorting a stock in general. So basically, when you write a call, you effectively short your own stock at strike price plus the premium you collected. With this comes the risk associated to shorting the stock, with infinite risk. Let's say the stock shoots up way past your expiration, your strike price. Well, for every dollar above your strike price, you lose $100 by having to sell below the current price. You cap your gains. But again, if you pick conservative strike price, the issue can be managed through rolling over your position higher, so to a higher strike price and further out in the future. We'll see a great example that applies to me, which is for the ticker symbol Palantir, a stock that I bought at 929, roughly around, what was that? Can't even see it now. It runs so much. So roughly around here, I noticed that it had weekly expiration dates, and I thought, I love the company. I think what they're doing is great. They have room to run. My problem is I never anticipated this crazy run. So I started selling covered calls all the way up, $15, $17, et cetera, until it shoots up. I think that's when it started becoming complicated for me. So my call was in the money. I had to roll it over. So what does that mean? I'm currently, at the moment, short the 21.5. Where are you? Right here, 21.5 covered call, expiring on December 24th. I collected $165 in the process, and shortly after that, the stock went in the money. It blew past my strike price. What does it mean? The price of this contract inflated big time. So what can I do in this situation? Well, first of all, I want to wait for as long as possible, the closest as possible to this expiration date. So this contract has as little extrinsic value in it as possible, because I will have to buy this back. So spend money. So I want the time component of this contract to be as low as possible. This way, I only have to pay for the difference between the current share price and my contract. Let's say PLTR stays at 27. I want to buy at 5.5, so $550. But I do not have to buy it back and spend all that money on my own stock, which makes little sense and stinks as well. It hurts. So what I actually can do is buy back this contract and sell another one at the exact same time, further out in the future. And the further out you go, the more expensive contracts are. Obviously, because you have more time to accomplish the move. So let's say I want to keep collecting money in the process. I would then pick a contract that's more expensive. So I would sell a contract that's more expensive than the one I'm buying back in order to still collect credit in the process. And this, if I were to take one, go to 40, if I want more, I type more. So what does it do for me? Basically, I am pushing back the end of my contract, and I'm pushing up the strike price. So I'm pushing up the ceiling past which I stop making money and I start losing money. Okay. I do not want to sell Palantir at 21.5. I love the stock. It's part of my passive income strategy, and I need it for as long as possible. I don't want to hold on to it for the long term. And I want to keep selling covered calls right above the current share price all the way up forever, right? So that is the thought process behind the whole covered call passive income strategy. I hope this makes more sense to you. I hope you gain value from this whole tutorial, and if you did, feel free to drop a like on the video. It really helps the channel, and subscribe to the channel for more content like this. I will probably come out with a trading recap of this week. Today is Saturday, December 12th, 2020. and maybe we can see together how much that I was able to collect and what's my plan to next week. Am I forgetting anything? I think that's about it, guys. Thank you so much for staying with me up until now, and I'll see you in the next one. Take care.